The economic story of the current housing market. Don't worry, I'm not going to be giving you a crash course into the technicalities of economics, but rather this is a presentation that's going to give you some of the basics of the property market and how it works, how it functions. It's going to help you make better investment decisions or better buying decisions as a home buyer. Many of you may be like Maggie or may know someone like Maggie. Back in 2009, when the property market was hot and it was really easy to make money in the market, people were buying houses left, right and center. Everybody, including his grandmother and grandfather, was saying that you must invest in the property market because it was so easy to make money. But then something strange happened 6 years later, and that is people found out that capital appreciation wasn't happening like it was happening in the previous years. The good old days where you could buy a property for 500,000 and see it appreciate to 1 million within 3 years had gone. Suddenly people were saying that it's difficult. They couldn't understand the property market. What was happening? Why was it so easy to make money in the past and now it was becoming difficult? We'll explore this phenomenon. But I want to show you 3 separate stories. And these are stories that go over a longer span of time. So back in 1983, a family moved from Malacca to Kuala Lumpur, and they were looking for a house to purchase. They went and looked at houses in Damansara Heights, in Bangsa, in all the cool places in Kuala Lumpur. But they finally settled for a house in Taman United, which is in Old Klang Road. Now at that time, back in 1983, this was the backwaters of Kuala Lumpur. In fact, there were some red light districts and the access to Taman United was a small, narrow two-way lane. So it wasn't the best of places. They bought this bungalow house for 350,000 ringgit. By 2018, if you look at the chart here, the house was worth a cool 2.7 million ringgit. Now that's an appreciation year on year of about 6% every year over a period of 33 years. And then there's another story. Another family during the same time, around 1983, 1984, bought a house in Taman Seputeh. That family was my parents. And they bought this house for 235,000 ringgit. It was a 3-story semi-D house. And over the years, by the time it was 2018, this property had appreciated to 2.7 million ringgit. Now that's an appreciation of 6.34% year on year for the last 33 years. And a friend of mine, more recently, sometime in 2008, bought a condo, an apartment, a walk-up apartment in Puchong. He spent about 250,000 on this apartment, and by 2018 it was worth 600,000 ringgit. That's a year-on-year appreciation of 15%. Now what these 3 stories tell you is this, that over the long term, property price appreciation seems to be very stable. It's in the single digits, it's above inflation, it's better than bank interest rates. In the short term, if you look at the third story, between 2008 to 2018, another friend of mine who made this 14.68% year-on-year appreciation seemed to have done better than the long term. And that's because if you start buying a property at the start of a expansion, you actually make a lot more money. Now we'll look into this as well as we go, which is property cycles. Timing the market is very difficult, but if you can roughly gauge or estimate when a expansion is happening, when a recovery is happening, and when we are in a recession, it will help you make fantastic investment decisions. Now, looking at these 3 stories that I've just told you and benchmarking it against someone who had put, like say, for example, the bungalow in Taman United, 350,000 was the cost for it. If someone had taken 350,000 ringgit and put it in a fixed deposit in 1983, it would have yielded about 1.9 million. If you look at the grey line there, that's the fixed deposit rate. So the fixed deposit rate between 1983 to 2018 averaged 5%. Back in the 80s, fixed deposits were giving very high interest. But you can see that the difference, like if someone had taken 350,000, put it in a fixed deposit, they would have 1.9 million at the end. If someone had taken 350,000 and put it in a house, its value has reached 2.7 million. So it's a difference of nearly 1 million ringgit, which tells you that property investment is good, but you need to have some long-term, you need to have a long-term approach. So what I'm trying to get is that with some fundamental knowledge and an understanding of economic cycles, property investing is one of the most predictable ways to grow your net worth despite recessions. I repeat, despite recessions. Now, if you look at the three stories, why was I showing you property appreciation between 1983 all the way to 2018? Is because during that period, we've gone through three major recessions. We've had one in, we've gone through three major recessions. One was in 85, 86, then we had the 97 financial crisis, we had a 2008 recession as well. Despite those recessions, property prices appreciate, and the reason for it is behind the economic story. We're going to start with three often overlooked but critical attributes of property. And the first critical but overlooked attribute is that property is not liquid. Now, most of us think that property is going to make you financially secure. The truth is, property alone doesn't make you financially secure. Why? Unlike other investment classes like stocks or bonds or equities, you cannot sell your property tomorrow if you need the cash immediately. A property transaction, whether you're selling it or buying it, takes time, and therefore it is one of the most illiquid investments you can make. Therefore, it is not a replacement for savings. So most people take their savings, put it into property and think I'm secure. You're not. If you need the cash tomorrow, you're not going to be able to sell that property in time. So how a property transaction happens in Malaysia is like this. You have to find a real estate agent. The real estate agent goes out and looks for a buyer for you. This process can take anywhere from a month to 3 months. Now, once you get a buyer who is interested in purchasing your property and he pays the down payment or the earnest deposit for the property, signs a letter of offer, from that time to the time you get all the money for your property, the transaction is completed, okay? The time is 3 months to 4 months. So you're looking at a span of at least 4 to 6 months before you can transact a property you're trying to sell. Which means if you are in urgent need of funds, you're basically caught with your pants down. A lot of people make this mistake. They think that they're financially secure because they own 10 properties or 15 properties, but the truth is you're not. You always need to have savings, you always need to have cash flow and income to be financially secure. The other critical attribute of property is that there are ongoing costs. This is also often overlooked by home buyers or property investors, especially property investors. The math may seem simple. I buy a house for 500,000. My monthly repayments to the bank is 3,000 ringgit a month. And the rent I'm able to collect from this property is 3,500 ringgit. So I'm making 500 ringgit in positive cash flow, right? Wrong. Because there are many costs that people forget about. Now let me give you some of these cost elements. Taxes. So on your property, you have quick rent and assessment that you have to pay. On top of that, you have JMB fees. That's if your property is a stratified property. You have annual improvements and maintenance. So every year you have repairs to do on this property. It could be a plumbing problem, it could be a leaking roof, it could be an electrical problem, but there's always things to be fixed in the property. And there's the annual maintenance of the property, meaning periodically you need to repaint your house, periodically you need to mend your fences, you need to mow the lawn. There's all these cost elements to maintaining your property. Then there is the memorandum of transfer if you're buying a new property. So the memorandum of transfer duty is quite significant. You have got mortgage insurance. So if you're paying an MLTA, it's an ongoing cost, you pay it every year. Then you've got your agent fee. So if you're renting out your house, every time you find a new tenant, you have to pay a fee to the agent who brings the tenant to you. That's an ongoing cost as well. Now, when you factor in all these costs, right, most people will find that although they thought they were going to get positive cash flow from a property because they did the simplistic calculation of mortgage, rental minus mortgage, instead of looking at all the costs and annualizing them, they find that instead of getting positive cash flow, they actually have negative cash flow, or at best they're breaking even. So this is something you need to be very, very careful of. Now, why is cash flow important? One of the reasons is this: cash flow gives you holding power. So if you have positive cash flow, no matter what your financial circumstances, unless it's severe, you are always able to hold that property without encumbrance to yourself. So you don't really have to sell the property. You're not in a position where you're bleeding money on the property. You're able to hold it. And as long as you can hold your property, you never have to sell it at a loss. You can just continuously keep it until a time where there's good capital appreciation on the property or you're going to make money on the property. So cash flow is really important to giving you holding power. The third critical attribute of properties is this, that there are vacancy periods. Again, this is often overlooked by most home buyers and property investors. What does vacancy periods mean? If you're buying a property, it's an investment property, meaning you're buying to rent it out to people. There are periods where there's not going to be a tenant in the property, and when there's no tenant, the property is not generating income for you. A lot of us forget to include this cost, and let me tell you let me do the math for you. Let's say you're getting 3,000 ringgit per month on a property, right? You would assume that your yearly rental income is 36,000. But in every year between tenants, if assuming your tenancy periods are for 1 year and then your tenant leaves and you have to find a new tenant, while your tenant leaves, in between the period of your tenant leaving and you finding a new tenant, if it takes say 1 month, right? That means for a month your property is unoccupied. You actually have to deduct 3,000 ringgit because it's a loss for you. It's a loss of income. You're not getting that 3,000 ringgit for that month. Your actual rent you're collecting in a year, therefore, is 33,000. And if you deduct your agent fee, because you pay an agent 1 month rental deposit, your actual rent you collect is much less. So without taking into consideration the agent fee, just looking at the fact that your property is vacant for a month, between tenants, the actual rent you collect over a period of 1 year, in this case, is 2,750 ringgit instead of the 3,000 ringgit you thought you're getting. Another reason why vacancy cost is so important for you to understand is because it helps you make better buying decisions. This is a real life example that I experienced. I was once looking at a property that cost 520,000 ringgit. It was a studio apartment. It was on a very high floor, very well furnished with a fabulous view of the Twin Towers. In the same apartment complex, there was another person selling the same size studio for 450,000. It was on a lower floor, the decor was not as great, and it didn't have the fantastic view of this 520,000 ringgit studio. So I've got two studios that were similar sizes, exact same layout, but one was on a higher floor, had a better view, cost more. The other one was cheaper on a lower floor without a very good view. Now, on the outset, as a property investor, you would think that you should go for the cheaper property, right? 450,000. It makes more sense if just looking at it on the surface to buy it cheap, because you can make more money from the rent. But the thing is this, the 520,000 ringgit studio was able to fetch a rent that was about 200 ringgit more. And the vacancy periods were less. So this person that owned the apartment before was able to get tenants without stop, meaning there was no break. There was actually no vacancy period between tenants. So when you do the math, when you don't have to deduct this vacancy cost, right? Over the long term, the yield on the 520,000 ringgit property was far better than the 450,000 ringgit property. So when you start looking at vacancy cost, it helps you make better investment decisions. Now, so those were the three critical attributes of property. Let's look at how you can maximize what I call the wealth generators in property. So the first wealth generator is, again, cash flow. Cash flow is super important when you're investing in property, especially if you're buying to rent. And the reason is this: it can make or break your investment. This is a typical costing for a property that is 400,000 ringgit. And if you look on that side, that's all the operational costs. So these are running costs. You've got the insurance, you've got water, you've got the vacancy costs, you've got repairs, monthly service fees. And then if you look at below that, there's annual improvements as well. So this is money that the person is spending every year on the property, right? You would think that based on the monthly repayment of 1,537 and the rental price that he's getting, which is 2,000 ringgit, he is making a positive cash flow, even if you factored in the building service fee and sinking fund. But if you factor in all the other operational costs, he's at negative 774 ringgit. Now, if you're able to calculate your costs accurately, you will know whether you can handle this negative cash flow. A lot of people, they don't know, they're not sure because they think they're getting positive cash flow, so they go and buy property, but then their income is neck to neck with their expenditure. They cannot handle this cash flow. And when times get bad or their income is affected, for example, in this this COVID-19 period, lots of incomes are affected, they're unable to hold on to a property. And if you're unable to hold on to a property, that's when you get into serious trouble, because you have to sell it at a price that may not be profitable to you. You have no choice. So how do you maximize your cash flow? You maximize your cash flow by looking at your cost elements here. Once you understand that these are your cost elements, the operational cost items that I'm showing here, you can play around and tweak them. For example, instead of investing in a property with high vacancy periods, you invest in a property that has very low vacancy periods. That means you look at properties that are high in demand among tenants. You look for properties that are well decorated, that have been decked out nicely, that people want. Or you spend some money on renovations, right? Like here I've put 40,000 on renovation costs. Maybe you spend 50,000 on renovations to reduce your vacancy period. You can also increase your rent. So you spend more on renovations and increase your rent a little. You could increase your tenancy period. So instead, like if you look there, the rental fee for the agent is 2,000 ringgit. You have to pay this every year. So instead of having a tenancy that lasts 1 year, you can go for a tenancy that lasts 2 years, or push for tenancies that last 2 years. So you save on agent fees, you save on vacancy costs. When you reduce these costs, your cash flow becomes a lot better. By tweaking your cash flow, you would be able to reduce this to break even quite easily. Now, the second wealth generator is capital appreciation. This is actually where property investors make real money. Cash flow, your income from rental is not going to make you a millionaire. Capital appreciation is. So when you invest in properties, you want to maximize your capital appreciation. And a small increment in your capital appreciation can produce big results in your bottom line. Let me show you some examples. So the same property that I was showing you above, the 400,000 ringgit property, if you bought it and it appreciated every year by 5% over an 8-year period, you'd be looking at an annualized return of 8.31%. Now, this is pretty decent. It's much better than what banks are giving. It's as good as ASB this year, right? Very good. But if you invested in a property that had better long-term capital appreciation, let's say you looked at a property that was built by a reputable developer that has got a track record of good maintenance, that is close to amenities, that has got good access to townships, that is close to public transportation and so forth, and you increased the potential for your capital appreciation by 1%, just 6%, right? Look at the jump in your annualized return. From 8.31%, you move to 11.33% per annum annualized return. This is fantastic returns. It's much better than mutual funds or unit trusts in terms of percentage. And if you had a long-term approach because you are thinking about capital appreciation and kept the property for 12 years instead of 8 years, your annualized return is 12.1%. Your total return is 294%. Now that makes your investment fantastic. So when you're looking at properties, you're looking at these wealth generators, you're looking at cash flow, you're looking at maximizing your capital appreciation as well. When you have that kind of mindset, that kind of thinking when you're buying properties, you can make a lot of money on your returns. The third thing is loan pay down. You want to maximize that as well. So loan pay down means how you're paying down the loan, the mortgage that you've taken on the property. And this is one of the reasons why if you bought a house to stay in, it doesn't make that property a fantastic investment. But if you buy a house to rent, it makes it a fantastic investment. Let me show you why. If you look here, you're collecting a monthly rent of 2,000 ringgit. And this, because of this monthly rent that's happening, you are offsetting a lot of your costs, especially the interest on the mortgage. The interest on your mortgage can be very heavy over 30 years. So just on interest alone, you bought the house for 400,000. Just on interest alone, you may be paying somewhere equivalent to that amount, right? But because someone is offsetting your interest payments, your yield when you sell the house, your capital appreciation is good. You get 13.22% annualized, okay? If you don't collect any rent, no monthly rent collected, that means you bought the house to stay in, right? So you don't have monthly rent, no one is offsetting the interest cost of your mortgage. Your annualized return, if you sell the property after 8 years, everything else being the same, is only 1%. You are better off keeping that money in fixed deposit and earning 3% per annum. So the difference is huge between renting, that means buying to rent, and buying to sell. So when you purchase a house, you should be thinking about this loan pay down as well. Who's going to be paying the loan? If you're able to offset the loan through rental, then you're going to be doing really well. But if it's a buy to stay, you're not maximizing your loan pay down. Doesn't mean you shouldn't buy a property to live in. I'm just telling you that your returns diminish significantly. Now the fourth element is tax benefits. You want to maximize this as well. this is a wealth generator too. The most obvious tax benefit in Malaysia when you're selling or disposing of a property is RPGT. So if you sell off your property within a year, there is it used to be 30% RPGT. Now, for the moment, that RPGT has been reduced significantly. You want to look at that. So if RPGT is high, meaning you own a property for 1 year and you're going to have to pay 30% on real property gains tax, you're going to lose a lot of your profit. When RPGT is at its lowest, like right now, they've provided you these benefits where 0% on real property gains tax. You make more money on your profits. So you want to look at that. If you're a company owning property, you want to see how you can maximize your tax benefits. Look at this as much as possible. I'm not a tax expert, so I can't advise companies, but I can give you the most obvious one is try and save on the real property gains tax. So we've covered the 3 critical attributes of property, and we've looked at the 4 wealth generators which you should maximize. Now let's look at economic cycles. I believe that the property market follows an 18-year cycle. The first person to have written about this and was a proponent of the 18-year cycle was Homer Hoyt. He noticed this cycle when he was recording the property appreciation in the US. Another person in more recent times who made this 18-year property cycle popular was a British economist, and this person, Fred Harrison, predicted the 2008 housing crash in the US and UK. Now, how this 18-year cycle works is you have 3 phases: a recovery, an explosion, and a recession. And it's divided into 18 years. The recovery period is 7 years, the explosive period is 7 years, and the recession is for a period of 4 years. So in total, it makes up 18 years. During the recovery phase, you will see that not many people are buying into the property market. This is the period which is just following a recession. Only smart investors in the economy are buying. So it's very few people, only they are buying properties, and appreciation is very low. It's typically in the low single digits. You're looking at like 2%, 1% capital appreciation. Credit starts to become a little easy. So during the recession, banks and lending institutions were tightening their credit policies. But as a recovery is happening, banks and lending institutions start to ease their lending policies. So it becomes a bit easier to borrow money. The notable thing about this phase is that there is a mid-cycle dip. So if you look at the chart here, over here there's a mid-cycle dip. So when this mid-cycle dip happens, everyone has just come out of a recession and we're experiencing a recovery, and then there's a slight dip, there's a dip in property prices or transactions. People start to panic and think, oh my God, another recession is coming, because the past recession is just fresh in everyone's memory. But what happens instead is something very interesting, because immediately after the mid-cycle dip, we enter the explosive phase, and that's when you see real growth. This is when growth can be double-digit numbers. Younger investors have forgotten the recession, so everyone is gung-ho about the market. At this point in time, everyone will be telling you to invest in the market, similar to the story of Maggie that I started off this presentation with, where everyone thinks making money in the property market is easy. You will also start to hear of big grandiose projects. So just at the peak of the housing explosion in the 90s, you were hearing of things like Cyberjaya, Putrajaya. That was the time when the Petronas Twin Towers was built and completed. That was the time we had the KLIA airport, things like that. And if you look at the second phase, right, as we came into the next property explosion, which was 2009 onwards to about 2014, 2015, you started hearing about Bandar Tun Razak. You heard about PNB 118, massive projects, right? 8 Conley. You hear this during the explosive phase. And during this phase, credit is also easy. Interest rates are going up and banks are quite easy on their lending policies. This is a period that you need to be very careful about because there's something called the winner's curse. Why is it the winner's curse? Because when you're at the peak, right, this is when everyone will be trying to enter the market. Everyone will be rushing to buy properties then. That is actually, if there is a worst time to be buying properties, that is it at the peak, because immediately after that, it's followed by a recession. So what it means is, instead of seeing continuous capital appreciation like it happened in the previous years, the market is going to take a dip. In Malaysia, a dip means usually the market plateaus. We've never really seen serious dips in property prices. So the recession phase, in the recession phase, prices have become very unaffordable. Banks tighten their lending policies. People are locked out of the market. It is a buyer's market, and that's this phase. Okay, we have experienced that in recent times. So it started happening in 2015 to about 2019. We're still going through that phase because it's been extended by COVID-19. It's a buyer's market. Prices have become unaffordable. Banks are tightening their lending policies, and people get locked out of the market. People get locked out of the market because things like incomes are not high enough to support purchasing properties in the property market. So what is this cycle telling you? The cycle, I'd like to emphasize here, is not an accurate predictor of the future. So it doesn't tell you exactly when we're going to have a recovery. It doesn't tell you exactly when we're going to have a recession, but it gives you some indication. So the moment, as an example, the moment you see everyone telling you to be going into the property market, to be buying, and everyone is rushing, and growth is at double digits or near double digits, you start to hear grandiose projects are being announced. That's when you need to become cautious about the market, because it's telling you that you are reaching the peak of an explosion. The moment you see banks tightening their lending policies, you see that the market is starting to become a buyer's market, right? Capital appreciation is not as high as before. You know you're in the recession stage. And the moment you see that the property prices are not dipping anymore, transactions are not dipping anymore, but they're starting to pick up, you know you're going into a recovery. So we could tell this actually in 2019. NAPIC released data in the first half of 2019 saying that property prices and transactions in 2018 had picked up for the first time in 3 consecutive years. You were seeing an uptick in volume and prices. Now, most experts agreed that this was an indication the market had bottomed out and we were headed for a recovery. So that's an indication. But what happened after 2019 was something no one foresaw, which is COVID-19. COVID-19 has just extended the recession period by about 1 to 2 years. So although it doesn't give you, it's not an accurate predictor of the future, it gives you very important insights. First, it tells you this: the market has got ups and downs. There's cycles. So you've got your recession, then you've got your recovery, then you've got your explosion, right? You've got your recession, recovery, explosion, and recession again. And then it's followed by a recovery, explosion. So there's this cycle, right? And it's up and down, but the up or the high point of every new cycle is always higher than the previous cycle, which means that the general direction of the market is up. So if you have a long-term approach in the property market, especially in countries like Malaysia, let's not talk about Japan, because Japan is an aging population. So there you don't see this phenomenon. But in Southeast Asian countries where population is growing, you've got very young population, the property prices are generally headed upwards over the long term. And this is a clear example. So this is the American, I was only able to get data for the last 100 years from Case-Shiller, which looks at the American market. But it shows you that despite all these dips and everything, the general trend of the property market in terms of prices was up. The second insight that you can glean from the property cycle is this: it is important to see the big picture. So, you might see recession, you might see an explosion, but you need to always keep a bird's eye view, meaning you need to be aware that a recession never lasts forever. It's always followed by a recovery and an expansion. And you need to keep in mind that an expansion never lasts forever. It's always followed by a recession. So as long as you've got these big picture overview on the property market, you tend to make better investment decisions or better buying decisions. You will not be panicking like the rest of the market. The third thing is you must have holding power. So from everything that I've spoken from the beginning all the way till now, you may have picked this up a few times, that holding power is important. If you're unable to hold on to your property, that's when you lose money. You see, selling your property or appreciation and depreciation on your property rather, doesn't really affect you financially until you sell it. So if you have a property that's worth 1 million and it depreciated and it's worth 800,000, or it never appreciated and it's just maintained at 1 million, there's no loss to you actually if you don't have to sell the property. If your property goes up from 1 million to 1.5 million, again, there's no real material benefit to you until you sell the property or you refinance the property. So as long as you're not selling the property, whether the property price goes up or not, you can't make much of it. The 500,000 in appreciation on your property, if you don't sell it, means nothing. You can't use it to buy anything. You can't use it to feed yourself or buy new property unless you sell or refinance, right? So until you sell a property, the ups and downs don't mean anything, which means as long as you can hold a property, right, whether it's a recession or whether it's a recovery phase, doesn't really matter because you can hold it indefinitely. It is not costing, it's not bleeding you, or the cost to maintain the property is not beyond what you're earning, right? You will never have problems with your property. The next thing that the property cycle is telling you is not to believe in hype. So if you notice that during the explosive phase, especially when you're approaching the winner's curse, you will hear of big grandiose projects. The media will be talking about how wonderful the property market is. Everyone, including his grandmother, grandfather and auntie, will be telling you, buy property, invest in property. It's the best way to make money. This is when you need to be very cautious because we are approaching a recession. Go in the opposite direction of the hype, and I'll explain to you why later. The next thing the property cycle is telling you, it's nearly always a good time to be buying property. So with the exception of that winner's curse period, almost any time is okay for you to be buying property as long as you have holding power, as long as you understand your cash flow, as long as you have made a good investment choice, meaning you bought on the heels of good fundamentals, right? You are okay. You are not really in trouble. You are going to make money from the property market as long as you have this long-term approach. Therefore, you don't. If you want to buy a house or you want to invest in property, you don't have to be too concerned with whether you are in a recession or whether you are in a recovery period. Other factors might come into play. For example, right now, a lot of people are thinking, should I be investing in the property market? With COVID-19, there's a lot of uncertainty with jobs, with incomes, and so forth. If you've got the fundamentals right, meaning you understand the cash flow, you understand capital appreciation, you understand how to maximize the wealth generators, this is actually one of the most opportune time to be buying properties. Interest rates are at an all-time low. Banks have been easing their lending policies. There's the housing ownership campaign 2020, where you don't have to pay deposits. A lot of duties have been a lot of duties at zero. You don't have to pay a memorandum of transfer fee and so forth. So the cost of acquiring a property during this period is actually pretty cheap and makes it a really good period to be buying if you can afford it, if you understand how to maximize the wealth generators, if you understand the three critical attributes of property, if you have a long-term approach and you understand how the cycle works. Now, what can we take from all this that I've just spoken about? Three key observations. The first thing is this: real estate professionals ignore cycles, especially in the expansion phase, because they make a lot of money then. So it's in everyone's best interest to be promoting properties at that time. So no one will tell you that a recession is coming. Everyone will be saying, wow, property market is great, and so forth. You need to be aware that the market is cyclical, that a recession will always be followed by a recovery. Expansion will always be followed by a recession. The second insight is this: the recovery and expansions that take place are faster and higher than expected. What do I mean? If you look at these charts, right, every time you see a recession, look at the recoveries. It's always followed by a very fast recovery. We saw this in 1997, we saw this in 2008, we saw this in 85, 86. Recessions, the recovery or the expansions always happen faster and higher than people expect. The third thing that this property cycle is telling you is this: good timing and a certain degree of contrarianism are essential ingredients to being successful in the market. That means understanding how the cycle works, at which phase we are in the cycle, can actually help you make a lot of money in the property market. What does contrarianism mean? It means doing the opposite of what everyone is telling you. So when everyone is telling you, buy, it's a fantastic time to be in the property market, we're probably approaching the winner's curse. It's not the best time to be buying properties. But when everyone is telling you don't buy and everyone is not investing in the property market, that is probably one of the best times to be looking at the property market. And this insight was proven by a very good study done by three researchers. I'll be providing you with my Facebook account later, so you can send me a message if you'd like to see that report. But in this very well written report, they found that all property investors who have been successful practice this. They had good timing and a degree of contrarianism. So that concludes my presentation on the economic story of the current housing market. I'd just like to recap the concepts that we've gone through. The first is we looked at the three critical attributes of property, which is property is not liquid, there are costs to maintaining property, and there is a vacancy cost that many people overlook. Next, we went into the four wealth maximizers in the property market, and that is cash flow, capital appreciation, loan pay down, and tax benefits. You must always look at how you can maximize all these four areas. And finally, we looked at the property cycle, which is an 18-year cycle. Now, the property market doesn't exactly follow this 18-year cycle. It can be shorter, it can be a little longer, but generally it's 18 years. 7 years of recovery, 7 years of expansion, and 4 years of recession. A little bit about myself. My name is Ikhram Merican. I'm a propreneur, which means I'm a property entrepreneur. I was very big into Airbnb. I was known as one of the most successful and experienced Airbnb hosts in Malaysia. In 2019, I closed my doors to my last guest on Airbnb. I remained as a consultant for some big operators, and I also blog about the property market. Today, writing is one of my passions, and I spend a lot of time writing about the property market and on personal growth. You can read my blog at livingspaceventures.com, and you can reach out to me on my Facebook, which is Ikhram Merican Official. Thank you very much.